Howdy, boys and girls. Welcome to the weekly wrap-up for March 11th, 2022. It's been kind of a week in the markets and, kind of a week as far as weather here in Colorado. We finally have some clear skies and the weather's going to warm up. Let's see, it's 29 toasty degrees outside right now at 4:30 in the afternoon. Mountain time here in Colorado. So got the driveway cleared off this afternoon and went out and ran some errands. So I'm a little late with my video this afternoon. I apologize. Other good news, the lockout with Major League Baseball is over. So that is some excellent news there. So our Astros are going to be playing sometime soon. I think the season's going to start on April 7th, I think, if memory serves me well. So that is excellent news for me because I am a seam head, I guess is the term people would use. I love my Astros. And frankly, I could just watch baseball because we have the MLB package since I don't live near Houston anymore. So I got to pay to watch them play their games. So with that package, for like a few extra, because you can either just get one team or you can get the whole league for like $30 or $40 more. So for an extra few bucks, I get to watch every base. Once the Astros are over, I'll flip over to the West Coast games and I watched a lot of Dodger games over the last couple of years living out here. So, but anyway, so I'm a little sad not going to be able to make it to opening day down in Houston since they canceled the first week or two of the schedule. So, I'll try to make some games this year. Maybe make another trip over to Kansas City to see them play at the K, which beautiful stadium. If you've never been to Kansas City, it's a really nice facility. It's not, it's probably as old as I am at this point, but for a 40 or 50-year-old stadium, they've taken really good care of it. So if you ever get a chance to go there, I would. August is a little hot. That's last time we were there. It was in August or September. It was a little toasty, but all in all, it's a nice place. And obviously the stadium here in Denver is really, really nice. Although I don't think the Astros are making a trip through here this year. So anyways, not that you came here to get your baseball news, but hey, I'm here to help. So if it's your first time watching, please click on one of those subscribe buttons. It's probably right there. Or if you're on Facebook, give me a thumbs up and a like. And if you could, share this with friends and family. I don't do a lot of advertising. So, word of mouth is how I like to spread the message of good financial sense. So, all right, let's go ahead and jump in and see how the indexes did today. Another down market day and week. The Dow Jones closed down 0.69% at 32,944. S&P was down 1.3%, closing at 4204. NASDAQ down 2.18%, closing at 12,843. Small caps were down about 1.5%. VIX was up again, closing at up 1.72%, closing at 30.75. As far as the other not indexes, but exchanges that are open here in the Americas, Canada was down, Brazil was down, Mexico was down, and then we get into Europe. The European market was up, at least Western Europe. Everything from the DAX in Germany all the way down to Turkey and the early or the Western Asian markets. So the only markets that were still closed in Europe were the Russian markets, which have been closed for over a week now. All right, so a couple down markets here. This is Israel, Saudis, Japan, Australia, and New Zealand were down. But the Asian markets, China and Hong Kong, all the Chinese markets are up. Hong Kong was down. Taiwan was down. Thailand was up. And then these smaller ones just kind of mixed. So all in all, for the trading day of March 11th, looked pretty good. The laggard was, here in the U.S. So again, there's a lot of crap going on right now. So, don't get too panicked. If you've already set up your portfolio to deal with this, you should be fine. If you haven't, you might want to consult with an advisor who can help you, make sure you're not taking too much risk and that you're also in some assets that can help you take advantage of the inflation. So if you haven't done that already, you might be running out of time. All right, well, let's take a peek at the indexes and see how they did for the week. The Dow Jones looks like it was down about 1.87. NASDAQ looks like it was down 4%. The S&P 500 down about 2.84. Dow Utilities down 1.03. And the Dow Transports down 1.02. So a red week across the board. And if you can see here on all my little securities I got all around here, these are my equity models right here, or equity holdings. They were all down. Bond holdings, the only one that was up was the TIPS, which is your Treasury inflation protected securities. So like I just mentioned, those are the ones that are going to do well with the inflation. So, but everything else sucked. So, all right, let's get that out of there. Let's take a peek at the economic data that came out this week. U.S. initial jobless claims came in at 227,000. The forecast was 217. Last week's number was revised up from 215,000 to 216, but still below what the forecast was. Continuing jobless claims came in at 1.494 million. The forecast was 1.46 million, so about 30,000 over forecast. Last week's numbers were revised down from 1.476 to 1.469 million, and again, which brought it back under the forecast for last week. So that's some, and again, the trend looks good. I mean, I do imagine if we do head into bear markets and potentially a recession, that we could see some job losses, just because of that. But those things do happen. All right, the the JOLTs report, job openings report, came in at 11.263 million. The forecast was 10.925 million. So was that about 300,000 more jobs than what was forecasted? So again, lots of jobs available. I mean, it's just a matter if they're high skills jobs, you're going to have to go out and get the skills to go and get that employment. So the consumer price index came out this week. The year over year number through February was 7.9%, right on forecast. So you can see we've gone from, let's expand this back a little bit. So from March of last year, we were sitting at 1.7% inflation. And the next month it was up at 2.6. And then we have been above 5% since June. And we've been above 7% since the beginning, since January. So, or I guess since the December number. So yeah, it's not real good. And at this point, I don't know how much longer this will continue to go up. We'll see what the Fed does this upcoming week. Are they going to, stick to their guns and raise interest rates 0.5% or 0.25%? I know they'll do something, but will they waffle and say, "Hey, we're not going to do any quantitative tightening and start selling off the balance sheet"? But we'll see. All right, the core CPI number came in at 6.4%. The forecast was 5.9%. And core is where it's excluding food and energy, some of our most important things. But even for it, when you take out food and energy, it's still inflation on other goods is still 6.4. All right. The consumer sentiment survey came in at a 59.7. The forecasters were expecting 61.4. So you can see, we've had a steady decline of the sentiment of the economy. So we've gone from December around a 70 number down to below 60 as of this latest report. So not ideal. All right. Was that the last one I had? And all right. I forgot to do the, it doesn't matter. All right. So I got a couple, 1, 2, 3 articles I want to breeze through here. So let me shrink that down so you can see my pretty face. All right. First one, S&P 500 in second weekly loss as consumer and war worries weigh. It's written by Yassine Ibrahim. All righty. The S&P 500 fell for the second straight week Friday as selling intensified into the close on signs of elevated inflation is hurting the consumer as the Russia-Ukraine war is set to roll into its third week ahead of the Federal Reserve rate hike. Consumer discretionary stocks led the broader market lower as investors digested data pointing to a wobble in consumer sentiment in the wake of surging inflation that ratcheted up a notch following the Russia-Ukraine war. Tesla, Las Vegas Sands, and Etsy led losses in consumer discretionary stocks, with the latter falling by more than 11%. The March University of Michigan Consumer Sentiment Index, which is negatively correlated with inflation, fell to 59.7 from 62.8, the lowest level since September of 2011. This latest leg down in the survey surely reflects the recent spike in gasoline prices since the beginning of the Russia-Ukraine war. Jeffries said in a note, but gasoline prices were going up before that. Signs of weakness in consumer, which is a key driver of economic growth, overshadowed hopes for a Ukraine-Russia agreement on a ceasefire after Russian President Vladimir Putin reportedly signaled positive developments in peace talks with Ukraine. President Joe Biden continued to up the ante on Moscow, calling on lawmakers to revoke Russia's most favored nation status, which could end normal trade with Russia, leading to higher tariffs. Technology gains a day earlier proved short-lived as the sector resumed its sell-off. Big tech as mostly in the red, with Apple and Meta platforms the biggest decliners. Meta was also pressured by concerns that user growth could slow even further after Russia restricted access to the social media giant's Instagram platform and launched a criminal probe into the company. The investigation was opened after social media giant changed its policy on hate speech to allow statements such as "death to Russian invaders" on its platforms. The weakness in broader markets comes just a week ahead of the Federal Reserve's two-day meeting, which gets underway on March 15th. Ahead of the meeting, Federal Reserve Chairman Jerome Powell has backed a quarter-point rate hike and said the Fed would likely begin talks about how to reduce its balance sheet. That remains to be seen. Chairman Jay Powell will be walking a tightrope, balancing the needs to raise rates and rein in more systemic rise in inflation with a need to avert a meltdown in credit markets, said Diane Swunk, chief economist at Grant Thornton. So let me pause for a minute while I blow my nose. Hold on. All right, I'm back. So yeah, I mean, that is not the best news, obviously. Removing favored status to Russia. I think we're playing a very dangerous game with a very well-armed nation, and pissing them off, I don't know if is really the best tactic, especially with, all the crap that's led up to this point. So I think, trying to smooth things over would be the best bet, but hey, what do I know? I'm just some schmuck sitting here in the mountains. All right, next article. Nichols price surge could threaten automakers' ambitious electric vehicle plans. I don't know if you've seen the news that Nichols had jumped dramatically in price over the last couple of days. They even shut down trading on the metal. All right, let's go and jump into this. The price of nickel is surging as investors take stock of the new global reality. Russia, a key supplier of the metal, is now facing extensive sanctions following its invasion of Ukraine. In an unusual step, the London Metal Exchange suspended nickel trading on Tuesday morning after 3-month contract prices more than doubled to over $100,000 per ton. Nickel is a critical ingredient in the lithium-ion battery cells used in most electric vehicles sold in and planned for the U.S. market. Its abrupt price surge has analysts and investors raising hard questions about automakers' ambitious electric vehicle programs. Morgan Stanley auto analyst Adam Jones has been among the loudest voices raising concerns. In a note published Monday, he said, quote, "As of this writing, nickel is up 67.2% just today, representing a $1,000 increase in the input cost of an average EV in the U.S., end quote. Jonas wrote that investors should reduce their expectations for automakers' earnings and for electric vehicle sales penetration over the next few years, as Nichols' abrupt price surge could undermine the ambitious EV plans put forth by global automakers, including General Motors and Ford Motor. All right, so high nickel batteries offer significant advantage for electric vehicles, but even before the Russia invasion of Ukraine, nickel wasn't cheap, and experts were raising concerns about the likely shortage as global automakers ramped up production of EVs. Analysts at Rystad Energy warned last fall that global demand for the high-grade nickel required for EV batteries is likely to outstrip supply by 2024, a message that has since been echoed by other commodity analysts, including Jonas's counterparts at Morgan Stanley. Given the relatively high cost of nickel and the concerns about supply that were voiced before Russia invaded Ukraine, automakers have signaled that lithium-ion batteries with high nickel cathodes are likely to be limited to premium applications. In those, the energy density is either required, as with heavy trucks, or a key selling point, as with luxury sedans. Assuming nickel's increase is sustained, the quick and obvious takeaway is that electric vehicles costs will go up, and more so for higher end EVs. Automakers who haven't locked up supply of nickel at pre-invasion prices will have a hard choice. They could choose to absorb the cost increase, reducing their profit margins, or they can try to pass it on to consumers. Most will likely do some of both. Not all EVs will be affected. There's an alternative type of battery that's already in use for lower cost EVs, although it comes with some trade-offs. Lithium iron phosphate, or LFP, batteries use iron phosphate in their cathodes, no nickel or cobalt required. LFP cells cost less than lithium-ion cells, but they also have lower energy density, which means that LFP batteries pack a heavier per mile range than their lithium-ion counterparts. That weight has made LFP batteries less than ideal for higher-end vehicles, as added weight limits their performance and can hinder the vehicle's handling. That's less of a concern with price-constrained mass market models. Chinese automakers, under government pressure to encourage EV adoption, have used LFP batteries in their low-cost electric vehicles for several years. And in this section, it talks about I didn't read through. Talks about how the batteries work. I didn't think that was really of that much importance. So you're welcome to read this article if you like. It will be attached in the show notes, so you can read that at your leisure. All right. Last article I mentioned this yesterday about gas prices. This comes from CNN Business, Chris Isidore. It's titled "Why U.S. Gas Prices Are at a Record and Why They'll Stay High for a Long Time." All right. Russia's invasion of Ukraine is a major reason that U.S. drivers are paying record prices for gasoline, but that's not the only reason. Numerous factors are combining to push gas prices up to a record. Gas hit $4.25 for a gallon of regular gas, according to a AAA survey on Wednesday. Gas prices were already expected to breach the $4 mark for the first time since 2008, with or without shots fired or economic sanctions imposed in Eastern Europe. So we were headed there already. So Russia had really little to do with where we're at right now. The inflation we're going to feel from right now is going to, we'll see that a year or two down the road. All right. Now, because of so many factors are playing at play simultaneously, drivers should prepare to pay uncomfortably high gas prices through at least Labor Day. Prices could easily reach $4.50 a gallon before they start to retreat, and even $5 per gallon national average is not out of the question. Here's what's behind the price surge. So obviously we know about Russia and Ukraine. The concern about disrupting global markets led Western nations to initially exempt Russian oil and natural gas from the sanctions they put in place to protest the invasion. Despite that carve-out, much of Russia's oil is going unsold on global markets. Traders are reluctant to bid for it when it's not clear that any deal can be closed, given the sanctions on Russia's banking system. There have been difficulties finding any tankers able or willing to call on Russian ports. This has resulted in a de facto ban on Russian oil in global markets, with investors pricing crude as if the country's supply isn't available. On Tuesday, the United States announced a formal ban on all Russian energy imports. The UK government said it too will phase out Russian imports by the end of the year. I imagine the conflict will be well over by then. And explore ways of ending natural gas imports. All right. Less oil and gasoline from other sources. When the pandemic-related stay-at-home orders around the world crushed demand for oil in the spring of 2020, oil plunged. briefly trading at negative prices. OPEC and its allies, including Russia, agreed to slash production as a way to support prices. Even when demand returned sooner than expected, they kept production targets low. So again, this is the important part, why gas has gone up so much in the last 2 years. U.S. oil companies don't follow those types of nationally mandated production targets, but they have been reluctant or unable to resume producing oil at pre-pandemic levels amid concerns about the prospect of tougher environmental rules that could cut future demand. Many of those tougher rules have been scaled back or failed to become law. So our oil refiners and drillers locally or domestically have basically been dragging their feet because they're worried about what the government is going to impose upon them. Quote, the Biden administration is suddenly interested in more drilling, not less, said Robert McNally, president of consulting group Rapid Energy Group. Quote, people are more worried about high oil prices than anything else, end quote. It takes time to scale up production, particularly when oil companies are facing the same supply chain and hiring challenges as thousands of other U.S. businesses. They can't find people and they can't find equipment, McNally added. It's not like they're available at a premium price. They're just not available. Oil stocks have generally lagged the broader market over the last 2 years, at least until the recent run-up in oil prices. Oil company executives wanted to redirect cash to buying back stock and other ways to help their share price rather than increase production. All right. Let's jump down here. Oil and gas companies do not want to drill more, said Pavel Molchanov, an analyst at Raymond James. They're under pressure from the financial community to pay more dividends, to do more share buybacks instead of the proverbial drill, baby, drill, which is the way they would have done things 10 years ago. Corporate strategy has fundamentally changed. Not only is oil production lagging behind pre-pandemic levels, there's also less U.S. refining capacity. Today, about 1 million fewer barrels of oil are available to be broken into gasoline, diesel, jet fuel, and other petroleum-based products. State and federal environmental rules are prompting some refiners to switch from oil to lower carbon neutral fuels. And some companies are closing older refineries rather than to invest the money it would cost to retool to keep them operating, especially with massive new refineries set to open overseas in Asia, the Middle East, and Africa in 2023. And major U.S. refineries have yet to return to full operation after two were damaged by hurricanes last year and another by an explosion. So that is the reason we are seeing such massive price hikes prior to all this Russia-Ukraine crap. So, to hear Jen Psaki and Joe Biden say this is the Putin price hike, I think is very disingenuous. Yes, it has something to do with it in the short term, obviously. But, gas, a year ago was far lower than we are today. And these are some of the reasons, because, the oil companies are, I guess they're either afraid or don't want to get into regulatory battles with the U.S. government. So anyways, all right. Well, that's everything I had for today. I hope everyone has a wonderful weekend. There's going to be plenty of college basketball on. So the Cougars won their first game this afternoon, which was nice. I was cheering them on. Go Cougs. And let's wish them luck tomorrow. They play at 1 o'clock Mountain Time on ESPN2. So for any of you Cougar fans out there, they'll be playing then. And if they win that game, they'll play in the conference championship game on Sunday. So, all right. Well, I hope everyone has a fantastic weekend. Get outside, get some exercise, have some fun. Don't let all the crap going on in the world get you down, because, one way or another, I think this government's going to run themselves, aground or into an iceberg and sink the ship. But the rest of us are going to be fine. We got our jobs to do. We got our lives to live. So once they crash and burn, we'll be able to just pick up the pieces and start over with hopefully a more free country. But, I'm a perpetual optimist. So, all right. Well, everyone have a great weekend, and I'll be back Monday with the weekly economic update and any other news that might have occurred over the weekend. So take care, and I'll talk to you then.